Good afternoon, investors. You are now on KleverStock with me, Madhveshwari, and I will be serving you the midday roundup with the latest market updates from this morning up until now. Kicking it off with the Bursa Malaysia updates, the FBMK LCI hovered around the 1,700 psychological level during Wednesday's morning session as investors processed a complex mix of military escalations and diplomatic signals from the Middle East. At 9:15 a.m., the benchmark index stood marginally higher at 1,701.76 as a strong recovery in banking heavyweights was largely offset by continued profit-taking in the energy and plantation sectors. Apex Research noted in its latest report that a volatile sentiment prevails in the global markets, with investors assessing conflicting developments in the Iran war and its implications for global energy supply. According to recent reports, the US military has successfully eliminated 16 Iranian mine-laying vessels near the Strait of Hormuz. This action follows a stern warning from President Donald Trump, who declared that any mines placed in the critical oil shipping route must be removed immediately. While the president suggested that the conflict could be nearing its conclusion, the research firm cautioned that military operations continue keeping geopolitical risks elevated. The global energy market saw a significant pullback, with Brent crude futures plunging toward $80 a barrel at their session low, a drop of approximately 11% at the timing of the writing. This retreat is fueled by growing speculation, and major world economies are preparing to release strategic petroleum reserves to stabilize supply chains impacted by the Hormuz bottleneck. Apex stated that against this backdrop, markets are likely to remain volatile as investors monitor geopolitical developments and policy response aimed at stabilizing global energy supply and inflation expectations. The divergence in sector performance was evident in the blue chip names. Maybank rose 14 cent to 11 ringgit 80 cent, while CIMB and Public Bank gained 6 cent and 5 cent respectively, buoyed by the stable domestic interest rate environment. Petronas Gas shot 16 cent to 17 ringgit 44 cent, and Petronas Chemicals dropped 9 cent to 3 ringgit 84 cent. SD Guthrie and PPB also saw declines as commodity prices softened. There was a mild rebound in the aviation sector as route closure fears slightly eased. AirAsia X rose 2 cent to 1 ringgit 31 cent, while its sister company Capital A gained 0.5 cent to 45.5 cent. Traders are expected to remain in a wait-and-see mode throughout the day, balancing the positive impacts of lower energy cost on inflation against the lingering threat of a wider regional conflict. Moving on to our local currency and foreign exchange. The Malaysian ringgit opened on a steady note this morning, remaining unchanged against the US dollar while gaining ground against other major global currencies. At 8 a.m., the local note was quoted at 3.9200 or 3.9355 against the greenback, mirroring Tuesday's close. The currency stability is boosted by fresh data from the Department of Statistics Malaysia, showing that the country's industrial production index rose 5.9% year-on-year in January 2026, driven primarily by a stronger performance in the manufacturing sector. Bank Muamalat Malaysia Berhad chief economist Dr. Muhammad Afzal Nizam Abdul Rashid noted that historical data confirms economic activities have been resilient. Afzal Nizam said that, however, it remains to be seen how such momentum can be carried through in the months following the shock of the war in Iran. He also emphasized that some countries are now grappling with high oil prices as fear over inflationary pressures seeps in, which may lead the ringgit to remain sideways against the US dollar today, likely within the region of 3 ringgit 90 cent or 3 ringgit 95 cent. The situation in West Asia continues to influence market sentiment. Dr. Mohammad Afzal Nizam explained that conflicting signals from the Trump administration have led to volatile moves in Brent crude, which touched as high $94.08 per barrel, but later stabilized around $87.80 per barrel. In the broader global landscape, the US dollar index fell 0.35% to 98.826 points, while spot gold prices hovered at $5,192.74 per ounce. Additional global economic data provided a mixed backdrop. China's exports jumped 39.6% in February, while Japan's fourth quarter 2025 gross domestic product performed better than expected at 1.3%. Locally, the ringgit exhibited strength at the opening bell against several major peers, rising against the Japanese yen to 2.4796 or 2.4896, the British pound to 5.2606 or 5.2814, and the euro to 4.5519 or 4.5699. Regionally, the ringgit's performance was varied. It edged up against the Singapore dollar to 3.0784 or 3.0910 and remained flat against the Indonesian rupiah at 232.4 or 233.4. Conversely, it fell slightly against the Thai baht to 12.4055 or 12.4659. As investors monitor the fluid developments in the Middle East, the local node is expected to continue navigating these mixed global signals with a focus on domestic fundamental strength. Now for some local economic news. Malaysia's technology sector is projected to transition into a more measured growth phase as global uncertainties compel corporations to tighten expenditure and refine cost management. While investment momentum remains fundamentally intact, BIMB Research cautious that the exponential trajectory seen in recent years may temper due to rising energy prices and heightened geopolitical risk. The brokerage has reiterated its neutral stance on the sector, noting that the primary challenge is a shift toward cautious capital deployment rather than a collapse in demand. A significant overhang for the industry remains the unpredictability of United States trade policy. Although President Donald Trump recently reduced certain tariffs from 19% to 15%, the brokerage warned that further reviews of adjustments could continue to weigh on market sentiment. BIMB Research stated that the key risk is not a halt in investment but a moderation in growth, particularly as rising energy costs increase pressure on margins. Additionally, the ongoing conflict in Iran has introduced a layer of geopolitical risk that is difficult for investors to price in, affecting supply chain stability and industrial energy expenses. Despite these headwinds, the demand of artificial intelligence infrastructure remains a resilient bright spot. Hyperscalers and service providers are continuing their race to secure computing capacity for next-generation AI models, a trend supported by recent strong results from global players like Broadcom. Consequently, BIMB Research favors companies with exposure to industrial and AI-driven demand over those focused on consumer electronics. The brokerage identified selective accumulation opportunities during the market pullbacks, focusing on firms with clear backlog visibility or niche technological advantages. Top picks within the sector include Zetrix AI Berhad, with a target price of $1.30 based on its scalable blockchain platform, and Victrox Corp's Berhad, targeted at $5.20 due to its strong order backlog. Dagang Next Change Berhad is also rated as a buy with a target price of 35 cents, as it's seen as a potential laggard player that has yet to reflect higher oil prices in its valuation. Furthermore, Inawi Amertran Berhad had already upgraded to buy with a RM1.92 target price, with analysts expecting loading volumes to improve following product qualification. Overall, the recently concluded earnings season was mixed, with two companies exceeding expectations and two underperforming with a brokerage coverage. Continuing with corporate news updates. While rising global geopolitical tensions have rattled international markets, economists suggest Malaysia could find itself in a unique position to benefit from the turmoil. Driven by a projected 20% surge in liquefied natural gas and palm oil prices, the ongoing conflict may provide a significant boost to the nation's exports revenues. Prof. Emeritus Dr. Bajai Badai noted that as one of the world's key LNG suppliers, Malaysia is poised to gain substantial from price hikes. Furthermore, since Malaysia and Indonesia combined control approximately 85% of the global palm oil supply, any price increase exceeding 20% would translate into significant windfalls for the domestic economy. Malaysia, specifically oil trade dynamics, are also expected to cushion the country from the full impact of rising energy costs. Bajoya explained that Malaysia primarily exports high-value sweet crude while importing cheaper heavy crude for domestic refining. As global prices rise, the premium earned on sweet crude exports helps balance this increased cost of imports. However, he cautioned that the supply chain for heavy crude remains a concern, as Malaysia relies on imports bonded at offshore trading hubs involving sources such as Russia, Saudi Arabia, and Iran. Sanctions and maritime disruptions could complicate the direct acquisition of these essential domestic fuels. Should geopolitical tensions disrupt traditional Western markets, Bajoya suggests Malaysia may increasingly pivot its trade focus toward ASEAN partners, including China, Japan, and Taiwan. These markets already represent a massive portion of global trade and could provide the necessary stability to sustain Malaysia's economic activity if global trade patterns realign. Conversely, he warned that the current conflict might signal the onset of a new economic downturn, observing that recessions have historically occurred roughly every decade since the 1950s, with the last being the 2020 COVID-19 recession. He indicated that the next major cycle could emerge towards the end of this decade. Center of Market Education CEO Dr. Carmelo Falito emphasized that Malaysia must take proactive steps to manage trade route disruptions. He recommended improving port efficiency, customs clearance, and diversifying shipping routes for key industrial inputs. Falito also advocated for continued economic reforms, particularly the reduction of blanket subsidies. He argued that moving toward targeted assistance would allow the market to adjust more efficiently to global price signals while ensuring vulnerable groups remain protected. Strengthening the monitoring of freight insurance and inventory risk is also seen as critical to preventing volatility from cascading through domestic supply chains. We'll now take a short break, but don't go away. We will return shortly with corporate news developments. Welcome back to the Midday Roundup. Let's continue with some world news updates. President Donald Trump has signaled a potential shift toward concluding the military campaign in Iran, predicting that the conflict will be resolved very soon as he balances military objectives against mounting economic pressures. Speaking at a news conference at his Doral resort in Florida, the president indicated a willingness to waive certain oil-related sanctions to stabilize a volatile global market that saw crude prices surge toward $119 a barrel earlier this week. "We are looking to keep the oil prices down," Trump told reporters. They were artificially up because of this excursion. While he acknowledged that the conflict likely would not end this week, he insisted that military operations are ahead of schedule and that the United States is currently crushing the enemy in an overwhelming display of technical skills and military force. A cornerstone of the administration's immediate strategy involves the U.S. Navy escorting tankers through the Strait of Hormuz to ensure the free flow of the energy. The president warned of bombing at a much higher level in Iran attempts to disrupt these critical shipping routes. Military data presented by the White House suggests that Iran's missile capability has been degraded to 10%, with drone launches decreasing by 83%. Despite this, the president vowed he would not relent until the enemy is totally and decisively defeated, including potential strikes on electricity production facilities if necessary. The president's shift in rhetoric follows a series of high-level diplomatic calls. This includes a discussion with Russian President Vladimir Putin. While Russia remains under sanctions for its war in Ukraine, the White House is exploring temporary waivers on certain oil-related sanctions to boost global supply, which is the move that could include allowing nations like India to purchase stranded Russian crude. This diplomatic pivot coincides with efforts from the Group of 7 finance ministers who expressed readiness to release strategic oil reserves if supply disruptions persist. Although Brent crude futures pulled back to approximately $87.80 a barrel following Trump's remarks, domestic pressure in the U.S. remains high, with gasoline prices projected to hit $4 per gallon ahead of the November midterm elections. Up next, we have some business updates. Sunway Healthcare Holdings Berhad, upcoming debut on the main market of Bursa Malaysia, has seen a wave of investor enthusiasm, with its retail portion recording a 5.57 times oversubscription rate. The high demand underscores market confidence in the group's expansion plans within the private healthcare sector. Malaysian issuing house Sendirian Berhad, the balloting agent for the exercise, confirmed that the retail offering of 230 million new shares received a total of 77,236 applications and for approximately 1.51 billion shares. Both the institutional and retail prices have been fixed at RM1.45 per share. The oversubscription was notably driven by the other Malaysian public category, which saw a staggering 10.37 times oversubscription rate, with 67,264 applications for 1.31 billion shares. In contrast, the Bumiputra public portion received 9,972 applications for the 202.7 million shares, representing an oversubscription rate of 0.76 times. Sunway Healthcare's listing is one of the most anticipated IPOs of the year, as the group seeks to leverage the capital for further brownfield and greenfield hospitals expansions. With the price now finalized, the market's focus shifts to the official listing date, where the group is expected to be one of the largest healthcare players on the local bourse by market capitalization. The successful balloting follows a period of robust performance for private healthcare providers in Malaysia, fueled by rising domestic health awareness and a steady recovery in the medical tourism sector. Finally, wrapping up, we have major corporate developments and deals across Malaysia. HSS Engineers Berhad, via its associate SMHB Sdn Berhad, has secured a 30.5 million ringgit consultancy service agreement with MMC Infrapadi Sdn Berhad. Kumpulan Kita Coin Berhad has secured a construction contract in Gombak, Selangor worth 89 million ringgit. RGB Berhad's 215 million ringgit acquisition of 2 leasehold land parcels in Johor Bahru via a joint venture with a Johor state-owned company has received approval from the Ministry of Economy, making the sale and purchase agreement unconditional. Next, G. Berhad Executive Chairman Dato Abu Hanifa Nurdin and Siti Nur Aisha Ishaq, who are linked to the company's largest shareholder Raya Aviation Holdings, have filed a court action to block his suspension and preserve the existing board and management structure. Bank accounts belonging to MMEG Holdings Berhad and NextG Bina Berhad have been frozen by the Royal Malaysian Police as part of the investigation under the Anti-Money Laundering, Anti-Terrorism Financing and Proceeds of Unlawful Activities Act 2001. Tianhua Press Holdings Berhad said its operations in Dubai have not experienced any material disruption amid current geopolitical developments in the Gulf region. Sarawak Oil Palm Berhad proposes establishing a new employee share option scheme of up to 10% of its total issued shares, excluding treasury shares, to incentives employees. That's a wrap for Midday Roundup with me, Madhveshwari, on KleverStock. Thank you for choosing us investors. Stay tuned for upcoming live stream programs.